The Federal Reserve are the ones who got us into this mess by printing trillions of dollars into existence, and now they're doing everything that they possibly can to get us out of this high inflation. The problem is the actions that they're taking are having a lot of negative impacts on the market itself. With interest rates being so high, consumers don't want to go out and get loans for mortgages, car loans, student loans, business loans, things like that. So in today's video, I want to talk about inflation, the housing market, bank failures, and what you could potentially do to prepare yourself for a market crash. Let's dive in. The Federal Reserve has said that they're going to be raising interest rates for an 11th time in the past 17 months. What this is going to do is going to help curb inflation, but at the same time, it's going to raise interest rates so high that it's going to price a lot of people out of the market from, like I said, going out and getting loans. So let's talk about something that might hit a little bit closer to home: food prices. What have they been doing over the past couple of years? Over the past year, food prices have risen by almost 5%, and the year before that, almost 11%. So what we've seen in just the past 2 years on groceries alone is almost a 16% hike in prices. That's not sustainable. What's happened with gasoline? Gasoline in 2021 went up by 49.6%. It dropped by 1.5% in 2022 and 19.9% in 2023. That means that gas is still up by over 25% in the last 2 years. Let's look at vehicle costs. With just 8% of new vehicles costing under $30,000, it's the least affordable car market in modern history. As you can see on this chart right here, the average cost of a vehicle in the United States was $12,000 cheaper than it is today. US dollar index, which is based off of other currencies around the world, is down almost 10% from its high last year. All right, let's talk about home sales here in the United States. As you can see on this chart, new home sales are up by 32%, but existing home sales are down by 17%. This chart is a little bit misleading though, because obviously the number of new homes is not anywhere near the number of existing homes in the United States. So this 17% number is a lot larger than this 32% number. This is very skewed to show that the market is not as bad as it actually is. Things are so bad that New York Post just put out this article about the new Zillow offers of 1% down payment to lure home buyers as mortgage rates hit 22-year high. Okay, the way I look at this is if things sound too good to be true, they're probably too good to be true. 1% down payments. Okay, if you can't afford to purchase a house, you shouldn't be purchasing a house. If you can't put 10 to 20% down on a home loan, then you can't afford to buy a house. It's that simple. This is giving me 2008 housing market collapse vibes all over again, because banks wanted to go out and give as many loans to as many people as possible without actually doing their due diligence and making sure that these people could afford these homes. And what ended up happening? One of the worst banking crises here in the United States. Okay, check out this tweet that shows off the home value to income ratio. It's never been higher throughout history. What does that tell us? That tells us that people are still making the same or less than they were, but yet the house prices continue to go up. This is 45% above the historical average of 3.1 times, with the median home payment now at a record $2,800 a month. Just think about that for a second. Could you afford a house payment of $2,800 a month? Most people out there couldn't. Now, granted, that's average for the entire United States, so you have to factor in places like New York and California. But still, that also factors in all of the rural places that have lower cost of living. The U.S. national debt is at an all-time high of $32.7 trillion, and the gross domestic product only at $27.4 trillion. We're at a spending deficit of $6.3 trillion. That's completely outrageous. A couple other things on here that are of interest is the U.S. total interest paid, the U.S. total debt, the U.S. personal total debt, credit card debt, and student loan debt. Credit card debt is now over $1 trillion. It's at $1.3 trillion. Student loan debt, $1.8 trillion. And there's more on that, actually. Student loan payments begin again in October. Interest starts accruing next month. There have been rumors swirling that a lot of people who've taken out these loans to go to school have said that they're just not going to pay them. I guess that's what happens when the government tells you that you don't have to. Michael Burry, who's infamous for The Big Short, you might have seen the movie, he shorted the housing market in 2008 and made an absolute killing. He's now taken a bet again against the market of $1.6 billion. The guy was right in 2008 about that crash. Will he be right again? Will lightning strike twice? Who knows? This article right here by NASDAQ was talking about Warren Buffett and his fears of the banking crisis continuing. In the past 6 months alone, we've had 4 bank failures here in the United States, and that number could easily go up in the next few months. As you can see on this chart right here, these bank failures have caused a loss of over $500 billion. With all of these things combined, I think we've set ourselves up for a perfect storm here in the United States. There are 4 assets that I believe will be good hedges against the failing economy. Now, before I get into those, please remember that I am not a financial advisor and nothing that I'm saying here is financial advice. This is for entertainment purposes only and to tell you what my strategy will be. My first choice above all others is obviously Bitcoin. This is a crypto channel and I strongly believe in the fundamentals of Bitcoin. I think that it'll be a great hedge against a failing economy. After all, it has no borders and no government is tied to it. Number 2 is the physical form of Bitcoin, and that is gold. I think that, again, it's not tied to any government, and it always holds its value pretty well. Number 3 is government bonds. With the Fed raising interest rates again for an 11th time, that means that the interest rates for bonds will also most likely go up. And number 4, for the same reasons as bonds, certificate of deposits are also a great hedge against a failing economy. That is, if you trust the banks, of course. Personally, I would rather own crypto and precious metals, but that's just me. I'm not blind and I can obviously see the value in CDs and bonds, but it's just not for me. If you're somebody that's a little bit older and you're just trying to retain your wealth, then maybe CDs and bonds are the way to go for you. There's obviously a lot more that could be said about the current market sentiment, but I'm trying not to take up too much of your time. If you enjoyed today's video, please be sure to hit that like button. And if you haven't already subscribed, please do me that solid. That's going to be it for today. Thank you so much for watching. Crypto Clay, out.